If you've ever traded, you know that feeling, right? That rush when a position goes your way, and that pit in your stomach when you watch it all disappear. Managing that risk, it's everything. And today, we're going to break down one of the most important tools you have for protecting your capital, the stop loss order. So let's start by framing the fundamental problem, the big dilemma that every single trader has to solve. It really all boils down to one critical question. Yeah, this is it. This is the core question. You've done the research, you've made your move, but let's be real. You can't be glued to your screen 24/7. So how do you stop a sudden market swing from just wiping out your account? How do you protect yourself? Well, what if you had an automated defense system for your trades? Picture a financial safety net that just catches you if the price starts to fall, all without you having to lift a finger. This tool actually exists, and it's called a stop loss. Okay, so let's get into the specifics. What is this financial safety net? And more importantly, how exactly does it work to protect your trades? At its heart, a stop loss order is just a really simple instruction you give your broker. You're basically saying, hey, look, if my investment drops to this exact price, sell it for me, automatically. It is your pre-planned exit strategy for when things go south. But here's what's really cool. A stop loss isn't just about playing defense. While its main job is to put a cap on your losses, it has a second, equally powerful function, locking in the profits you've already made on a trade that's going your way. And this is the real beauty of it. It takes the emotion out of the equation, right? And it removes that need to constantly stare at the charts. You just set your rules, and the system does the work for you. It gives you the freedom to step away from the screen with some actual peace of mind. All right, so theory is great, but let's see how this thing actually works in a real-world scenario. We're going to walk through a simple currency trade from start to finish so you can see it in action. So let's pretend you think the euro is about to get stronger against the US dollar. You go ahead and you buy the EUR/USD pair at a price of 1.1500. Okay, you're in the trade. Now what? Well, the very first thing you do is set up that safety net. Let's say you decide you are not willing to lose more than 15 pips on this trade. So you place a stop loss order at 1.1485. Now, if the market turns against you and hits that price, your broker automatically sells your position. Just like that, your maximum loss is defined and capped. Okay, so that's the defensive side covered. But what if you were right? What if the trade starts making you money and the price goes up? How does the stop loss help you then? Okay, let's say the price rallies all the way up to 1.16000. Nice, you're in profit. To protect those gains, you can manually adjust your stop loss, moving it up to, say, 1.1540. And this is so key. Your trade is now essentially risk-free. Even if the market completely reverses, you're guaranteed to get stopped out with a profit locked in. Now, moving your stop up by hand is great, but you can also automate this whole process. It's called a trailing stop. You basically tell your platform, hey, always keep my stop loss 50 pips below whatever the highest price is. So as the market climbs, your stop loss automatically follows it up, locking in more and more profit. And if the price falls, the stop stays put, ready to protect your gains. It only moves up, never down. So stop losses are obviously powerful, but, and this is a big but, it is so important to understand that they are not a perfect guarantee. There are some specific market conditions where they might not work exactly the way you think they will. And the number one problem, the primary challenge for a standard stop-loss order, is something called a market gap. A market gap is, well, it's pretty much exactly what it sounds like. It's a literal gap on the price chart. This usually happens between the market close on one day and the open on the next, often because of some major news. The price can open way lower or higher than where it closed, with zero trading in between. So going back to our example, let's say your stop was at 1.1485. But overnight, some bad news hits and the market gaps down, opening at 1.150. Because no trading happened between those prices, your stop loss couldn't possibly execute at your price. Instead, it triggers at the next available price, which in this case is 1.1450. That means you end up with a much larger loss than you planned for. And this brings us to a really key trade-off you have to understand. A standard stop loss triggers a market order. It guarantees you get out of the trade, but it doesn't guarantee the price. A stop limit order, on the other hand, guarantees the price, but And here's the catch. If the market gaps right past your limit, your order might not get filled at all, leaving you completely exposed. So to wrap this all up, what are the big takeaways? 1. Stop losses are an absolutely critical tool for managing your risk and protecting profits. 2. You can manage them by hand or automate them with trailing stops. 3. And this is important, they are not foolproof. Market gaps can and do affect them. And finally, you have to understand that trade-off between a stop loss, which guarantees the exit, and a stop limit, which guarantees the price. So now you get it. You understand how this critical tool works. But just knowing how the tool works isn't enough. The real question is, how are you going to use it? What's your risk strategy going to be? Thanks for checking out this explainer.